Hi, everybody. Welcome back to 10 Minutes with Griffin. I'm your host, Griffin Bridgers. For today's episode 128, we're going to look at ROBS arrangements. It's better known as a rollover as business startup arrangement, as we're going to see it's a way to finance a business startup using your balance in a prior employer's 401k or profit sharing plan. So for this part one, we're really just going to dive into basic issues with ROBS arrangements and then use this as kind of a launching pad into later technical discussions both on administration and exiting from a ROBS arrangement. Now, I like to preface this as always that the presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. I also want to preface this with the fact that my expertise is in tax and estate planning for individual clients and doesn't necessarily extend into qualified plans or ERISA or deferred compensation or any of those types of areas. I know enough to be dangerous in them, and minus a short stint doing some ERISA related work at a prior firm, I don't hold myself out to be an employee benefits attorney. So I really kind of am approaching this with the interest that I have a number of clients who I've come across who have this type of planning in place, and I want to address it adequately from the client perspective and kind of look into this just because very few people are really specializing in this particular area. So what is a ROBS arrangement? As I mentioned, ROBS is an acronym for a rollover as business startup. This was something that was promoted a lot, 10, 20 years ago, and it's shrinking in popularity for various reasons we'll talk about in a few minutes. But this was a strategy to finance a business startup by using tax-deferred funds in an employer's 401k or profit-sharing plan. So typically, even if you could withdraw funds from an employer plan while employed or after leaving employment, you'd have to pay tax on those, and you'd also have potentially a 10% penalty tax. But you can always roll over your balance in an employer's plan to an IRA or to even a new qualified plan if, for example, you change employers. Now, what happened is that typically this would be used to maybe start up a new business, which we'll see would be structured as a C corporation, and have that C corporation be your new employer and set up its own retirement plan, and then the funds could be rolled over from the old plan at your old employer into this new plan of your quote-unquote employer, which is really your business startup. So you wouldn't own the C corporation. Instead, the 401k that's administered for your benefit would own the C corporation stock ultimately. And in so doing, you could have a tax-free rollover, either from old employer's plan to new startup plan or through a conduit IRA into new startup plan. So these were used a lot, as I mentioned, especially 10, 20 years ago, usually for franchise types of businesses that are capital intensive in terms of the startup fees and licensing fees, but they could be used for other more grassroots startups as well. Now, this seems like it's a great idea on paper, especially as a source of capital where you don't necessarily have the funds in your own name or the leverage to go out and get financing. But what a lot of people gloss over is that for a qualified plan by an employer, there's a lot of compliance headaches that come in. That's why a lot of people tend to hire a company that would handle the compliance for this type of plan. So for one, usually a ROBS arrangement will be pushed by a promoter, and of course the promoter's happy to set up this new plan and get their fee and then just get out of there. They don't want to deal with the plan compliance. They'd usually set you up with somebody else in a lot of cases to handle that going forward, or just say, hey, you're on your own in terms of doing so. Now, while economies of scale have kicked in, that kind of reduce the costs for this, there is a lot of expense to setting up and maintaining an employer profit sharing plan, because you have to set up a plan document typically based on some sort of prototype. You have to get an IRS determination letter to approve that upfront plan. You may have to make plan amendments to that prototype as laws change, and typically you'd have to do annual reporting using Form 5500 or 5500 EZ, depending on the balance or value of the qualified plan. And the value is another issue, just because you don't really have valuable securities or cash in this plan. You have C corporation stock that's difficult to value. We'll touch on that in a minute. And if the plan has any sort of compliance failure, that you don't maintain the plan or amendments or annual reporting, you may have to go through a voluntary compliance program to fix the plan and correct it, through the IRS and maybe even through the Department of Labor, depending on the type of plan failure that is involved. Now, compliance aside, it's important to note that there's two bodies of law really involved here. One is ERISA, which forms really the framework of security and anti-abuse provisions for qualified retirement plans, because ERISA was designed to make sure that employees are protected from bad acts of employers and promoters of qualified plans. Then on the tax side, you also have the deferral of tax on contributions of your deferred salary or employer contributions to the plan, and the tax exemption of the plan as a trust itself, and then possibly excise taxes and penalties that can kick in for non-compliance and prohibited conduct within the plan itself. So from the outset, it's worth really kind of looking at this as in the big picture and confirming whether it's worth engaging in a ROBS that can come along with it, in lieu of just simply taking the tax hit of cashing out a 401k, if you could indeed do so. Now, it's important to note it's not just the ordinary income tax hit, it's also the potential for the 10% penalty for distributions, as well as the question of, could you even cash out the 401k or even the IRA once you've rolled it over? Now, there are some other restrictions to take note of. One is you can't do this with an IRA. You can use a self-directed IRA for some non-traditional investments. Now, we'll touch on that another time, but for now, really this is just something that can only be done with a qualified plan arrangement run by the C corporation that is the business startup. Now, with that being said, the new plan has to acquire qualified employer securities, which would generally restrict the range of investments to just C corporation stock for the company that owns the startup. Without that, the acquisition of that stock would be a prohibited transaction under ERISA and under the Internal Revenue Code. It's important to note that with a prohibited transaction on the tax side, there is an initial tax of 15% for each year that a prohibited transaction occurs, and if that prohibited transaction isn't fixed within that year, there's an additional 100% tax on a disqualified person who participates in that prohibited transaction. So that gives you an idea of the potential risk and cost of this ROBS arrangement. And it's also important to note that the new plan has to isolate your rollover in its own sub-account for your benefit, and that sub-account is what invests in the securities, and typically that would require some compliance and plan amendments even after you get the initial plan set up. So most often when you see people nowadays with a ROBS arrangement, the bigger question is not how can I set this up, but more how can I get out of it? Maybe you want to sell your business, maybe you just don't want to be saddled with this ROBS arrangement anymore. Now, much like there's ROBS promoters, there's also a lot of outfits that are really promoting the exit from ROBS arrangements for a fee. So it's important to do your homework before engaging any of those outfits. And the big issue here ultimately is whether you can get out of the ROBS arrangement without paying tax and penalties, or at least by minimizing those. Now, you may be able to sell the C corporation stock within the new plan and then reinvest the proceeds. You'd still have to incur tax when those proceeds come out, but that is an option you have. Another option, as we looked at in episode 122, is that you can liquidate your individual plan account and get capital gain treatment on the net unrealized appreciation in that C corporation stock. That could be helpful, especially if it's low basis stock, because you do have to pay income tax on the basis when that stock is distributed in kind. But keep in mind, you have to both separate from service and either cash out your entire plan, at least the C corporation stock, or just take an in-kind distribution of the stock and roll over the rest of the plan assets that don't consist of that stock. You could also look at in-kind distributions, but those would be subject to tax, and the issue would be the value of the stock. How much is taxed on distribution? And that could be an option if the NUA exception doesn't apply, but it could also have headaches. And this is on the IRS radar and has been since 2009. In 2009, the IRS took on a project to study ROBS arrangements and figure out the common plan failures, just because they saw a lot of people engaging in this. And anytime the IRS sees volume, its spidey senses go up, and they start to think, hey, is there an abusive transaction going on here? And ultimately, it hasn't quite reached that level yet, but the IRS does know what to look for. It does know some common plan failures. It's looking for those more intently, and it's possible that in the future, ROBS arrangements could shift into being abusive transactions in the eyes of the IRS. So new ROBS arrangements might be risky to enter into right now. And with that, if you're in a ROBS arrangement, until you can figure out a good exit strategy, it's important to take note of what the IRS acknowledges as common plan failures, just because they could be looking at your plan under a microscope for some of these. That could include things like prohibited transactions, failure to file Form 500 every year, failure to make the proper plan amendments, and even failure of non-discrimination requirements. Within a plan itself, you can't discriminate against highly compensated employees, and as the quote-unquote owner of the business, or the primary employee, the key person, you could be a highly compensated employee, and that's especially an issue if you have other employees who participate in the plan, and you may have to offer that plan to other employees as well who are in the business itself. Lots of issues there in addition to valuation, as I mentioned, but for the time being, I have more coming down the pike on this. This is an area I'll keep looking into a bit more for future content, but for the time being, remember, this presentation is vague for many reasons. One, I'm not an employee benefits attorney, and two, there's not a lot of info on this out there, which is kind of why I set out to tackle this, just because most of the people with info and content on this are those who stand to profit from setting up or helping with the exit from ROBS arrangements. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.